Hi, everyone, and welcome back to another episode of Unlocking Venture Capital. I'm here with Benny Lorenzo from Aspira. How are you, Benny?
I'm doing great. How you doing?
I'm doing well. So, Benny is the founder of Aspira, and I would love for you to talk about your journey and how you became a venture capitalist coming from the financial services industry, which, as we know, is a very which we believe to be a very natural way in. But I know that your
Yes,
story has a lot of turns.
it. I certainly did. As you know, I'm an immigrant and living the American dream. Uh, I was born in the Dominican Republic and immigrated to New York City. My mother got there first. She has been the architect of my life. I've been her only child, her only son,
Mm.
and she was a seamstress, and my father was a taxi driver. So very humble beginning. And I was very fortunate to focus a lot on education and did well in school and ended up winning a Regent Scholarship and going to Cornell University and studied engineering, uh, a Bachelor's of Science in Industrial Engineering Operations Research. And then from there, I worked for AT&T for a number of years and then made a pivot, if you will, to uh, to get an MBA from Harvard University, and I was very fortunate to get a full scholarship to go there.
Mm.
So I did that, studying marketing and finance, and coming out of there, most of my peers went to Wall Street, and I did not. I wanted to get some operating experience. Went to work for IBM for about 8 years or so. Ended coming out of IBM, having done a lot of work in sales and marketing, competitive analysis, and ultimately um, as a product manager for workstation products. So I came where the money was, where the money is, which is Wall Street, and started my career there as a sell side equity analyst, focusing on technology, media, and telecommunications. I did that for a number of years. Uh, Following that, I went to work in Silicon Valley for 3 years with a another investment bank. I learned a lot about Sand Hill Road and the venture capital is there. I love early stage companies and dealing with uh, entrepreneurs. Uh, from there, I came back to the East Coast, to New York City, and joined a friend of mine from Cornell University Engineering, an electrical engineer. He had started a hedge fund, a long short equity hedge fund in Greenwich, Connecticut. I joined him and we grew that fund from scratch to 350 million. And I left and I started Aspira Capital in 1996. So we've been around for a long time, quietly, making a lot of investments, close to, about 75, 80 investments over that period of time, number of exits. And Aspida really started out as a long short equity hedge fund, and we pivoted in 2012 to focus almost entirely on venture capital, angel investing and venture capital. Uh, we did that, and in 2021, we had really been successful. We had a 22% internal rate of return for about 28 years. So
That's
did
great.
very well.
Yeah, yeah.
Yeah, and it was good, and the track record helped. So we wanted to start another fund with a social impact to focus on capitalizing and mentoring women founders and underrepresented, underestimated founders. And we started that at the end of 2021. Well, you know what happened at the end of 2021? 2022 was a very tough year. We had a very hard time raising any money for that fund. So we seeded it with our own capital and decided to just start it anyway with 7 figures in capital and as a proof of concept that the concept really would work if we focus on the things that we knew from an operating standpoint, fintech, software, uh, e-commerce, mobility and health care, if you will. So, a team of us decided to just show that you could actually do well. Well, we did very well. That fund, we're closing it today, as a matter of fact.
Yay!
Yeah, it was, we ended up closing it early. It only lasted 3 years because we made 9 different investments, and one of them turned out to be a unicorn. So we were very good, but very lucky, whatever you want to do. But it was good. And now we're going to really use that proof of concept to raise another fund,
Yeah.
about 25 to $50 million with the same kind of thinking. So that's the story from beginning to end.
It's so funny that like it's so different than other fund managers where they also, came from Wall Street or a different kind of background or financial services like you did. But you're like, my first fund, I'm going to change it into a VC fund. I will wait 10 plus years
Right,
and
right.
then make this transition. I want to
Yeah.
see if this is going to work. And so other people who are, kind of young and jumping into it be like, let's try this and see if it fails. I'll give it a week. And
No, I
you
I
really
always
do every step.
yeah, I always thought this is a long-term game.
Yeah.
It's really decades. It's a good way to make money in a very slow way. You can make millions, but it's slow.
I
And you
think
have to have
that's so true.
yeah, you have to have staying power. So
Mhm.
we were fortunate because we were funding this from our hedge fund
Right.
fund, and that really helped us just go for a long time without really making money. So we were very fortunate in that stand. But we also had another uh, unicorn in our first fund, which was a company called Payoneer, fintech company that is now public. And we waited 15 years for that company to go public.
Oh my.
So we stayed there. We invested at 3.5 million valuation, and the company went public at around 2 billion. So that really helped.
So that was the unicorn that you referred to before,
Yeah.
yeah?
Well, that was one. That was no. There's another one.
Okay.
The second one came into this fund, the proof of concept fund to show that that you could really make money doing good.
Okay. And what did the other unicorn do?
It was in the same area in fintech.
Okay.
We invested in a company called Rev Worldwide. Um, it was founded by 2 entrepreneurs, Mexican Americans out of Austin, Texas, and they had started a company called Net Spend around 2000, was very successful. We were very early in the debit card area at that time, and they provided other products and grew that and took it public. So that company went public. They made quite a bit of money. It got sold eventually to Global Payments, which is a big public company in the fintech area. And Global Payments decided in 2022 to spin it out, part of it. They kept a piece of it and they spun out the majority of it. And these 2 entrepreneurs had started it back in around 2000, decided to make a bid for it. So they bid $1 billion for it and bought it. So we already had shares in this company as a little company, Rev Worldwide. So we were very lucky.
That is great. And so, your fund thesis has changed over the life of the fund. And
Yes.
that's really interesting because most of the time that doesn't happen, regardless of the market, regardless of conditions, regardless of anything. So, wanted to understand a little bit about your pivots and, how you're kind of seeing the impact of changing your investment thesis and changing your focus and evolving kind of over and over again, because I find that to be just fascinating.
Well, in terms of that, as I said, we started as a hedge fund,
Yeah.
and that really worked. But that was when making money in the hedge fund business was easy, if there ever was a time like that. But there was a time in the 90s and in early 2000s. But then it became very hard, particularly after the great economic crisis in 2008, 2009, where interest rates went to zero, and the market just kept going up. The market just went from about 11, 12 years or more, just a massive bull run. That was not favorable, as the record states, for hedge funds. You could not short stocks in that environment. So we saw that, and we saw how difficult it was to make our numbers. We felt that we had to deliver somewhere between 20 and 25%. And that's when we pivoted in 2012.
Okay.
And that helped. But the concept was to take our investors and the existing investors with us, and we did, and that really helped. In this business, as you know, it's all a matter of performance and trust, and developing trust through performance and through being very open and acting as a fiduciary, which a lot of people don't do in my business, the hedge fund business. So when we changed all of that to come into this model, and then it worked out for us. But it's slow. It just takes time, and you have to have a lot of patience with this. And I enjoy working with entrepreneurs, so that helped.
Okay, great. And so wanted to ask you, in terms of how you maneuvered and navigated and helped the startup that became a unicorn, went to exits and those kinds of things. What is your involvement and perception of the market at those times and during those times?
Well, in terms of initially Payoneer, those were Israeli founders. And I was fortunate because I have a very deep and expansive network, deal flow network. And it turned out that one of my very good friends was focusing on Israeli startups. Okay. And he got me into it, made the introduction. And a guy named Charlie Fetterman, who has a very, very nice fund right now.
Yeah.
And we're very close. Charlie was the one that had the idea, I cannot claim that. And I joined him, and so did he, so we worked with them. Payoneer went through ups and downs over this 15-year period, had two near-death experiences, but made it through because they were very, very good entrepreneurs. And, they were providing services, payment services to small, medium-sized customers, ended up acquiring over 5 or 6 million customers in 190 countries. So, but they went through a lot. As you went through the ups and downs, it was very, very tough. And they eventually came public via SPAC. When SPACs were, doing well, that was a very short window for them, but they hit it in 2021.
Why was SPACs doing well at this time?
Because they were new at that time, when there was a SPAC craze in 2020, 2021, and the SPACs didn't perform when they came into the public market. Most people, lost their money, and so that was not a good thing. But this company it's a real company, so they were able to go public, and they actually raised about 500 million, and still had over 500 or 600 million on their balance sheet. So they really did well. And we were fortunate because we understood the fintech business, and that's, we had a lot of experience there. So we didn't get shaken out as these things happen, which is usually what happens when a general partner sees is you try to sell your shares in the secondary market or something like that. We stayed with it. In fact, we bought more.
Speaking of the financial side, when you kind of first go into investing in early stage and everything is projections, because really you have a blank balance sheet.
Right.
The truth is, right? Did you find that to be kind of like, what am I supposed to do with this? Because I know that when I first got into early stage investing and everything was projections, right? You're either going to take it as is and believe it all, and find as much secondary research as possible. But at the end of the day, it's kind of like how are you, coming from a very, very extensive financial background, how are you kind of going into that when you first got into early stage? I'm so curious.
Well, yeah, I mean, we've seen hundreds of pitches. I
Yeah.
mean, literally for this, the second fund that we had that we're closing now, we saw close to 1,000 pitches, and we only invested in 9. So it just tells you what
Yeah,
this
yeah,
is like. And the issue is that we really don't believe any of the forecasts. I mean, that's not how we invest. We invest in the founders. We're trying to find great founders, gritty people, passionate, that are addressing a pain point, and we try to focus on founders that are really addressing a pain point or a solution that is solving a need to have problem. That is not just a nice solution; it's a
yeah.
needed solution that
Isn't
people
it?
will pay. So we look at our first screen is the team. And I mean that as a team, we don't invest in single founders. The founder has to have a co-founder that
Yeah.
complements their weaknesses and their strengths and so forth, and they work well. So we really focus on that, the dynamics, getting to know them, etc. And we take our time in doing the due diligence. Then we get into not only the idea and the forecast and so forth, and we tend to be conservative with those forecasts because they rarely turn out to be true. Most founders, when they're pitching, they're selling, as I'm selling when I'm trying to raise a fund. So when they're selling, they really are over promising and under delivering. And
Yeah.
I always counsel my founders and people that I deal with to under promise and over deliver. And that's a hard thing to do for an early stage company.
It also is particularly hard when you're fundraising.
Right. It's very, very hard. And the temptation is so outrageous on the other side that, the forecasts are usually never met. And you have to then, raise again, or the number one reason why these companies failed, and this is a very high risk business,
Hmm.
is, 65, 70% of them at least fail.
Yeah.
So what we focus on is increasing the success rate, reducing the failure rate by doing heavy due diligence and mentoring. And then as we mentor, we see if the founders are coachable, and that's something that you have to sort of determine. It is not a quantitative, it's qualitative. You have to determine how does this person take criticism or, suggestions or advice, or something like that. And I've found that founders coming out of the Ivy League schools, are very proud. They should be proud of what they've accomplished, and they're hardest to coach, in
Yeah.
my opinion.
Yeah.
So
But you
the
also
one
came from an Ivy League school.
I came from my life, and I know them quite well.
Oh, you're like, that's my frame of reference.
I know them quite well, and these folks are very smart and
Yeah.
very well prepared. So they feel that they really know more than most people. But my thing is you always can learn. So I'm always learning and I'm always curious. And so we gauge on how these founders take advice or don't take advice and work with us. We like to work with them. We find that the studies are clear that investors like myself that stay engaged with the founders throughout their life cycle and help them either by networking, connecting them to customers or more funding, et cetera, do better. The performance is much better than if you just put money in and forget about it and just hope that something good is going to happen.
Yeah, no, absolutely. I completely agree. And for a lot of founders that are creating a data room to send to investors for the first time, it's their first time doing it.
Yeah,
But it's
yeah,
also their very first time guessing what could happen, because they've never failed before, as they've
ex
done this.
exactly. And in order to sort of uh, accelerate the process, I joined a group of folks. I've been a long time member of the New York Angels,
Mm.
a very active angel group in New York City. And with us, about 10 of, there are 11 of us, we created an accelerator called Mentors+Angels, and it's a free accelerator. It's a 6-week program to really take entrepreneurs, founders, and really take them through a number of a curriculum where they can see what out of the questions that venture capitalists ask, that angel investors ask, what do they look for? How can you raise capital? And what are the things to do and not to do? Because what we found is that women in particular and underrepresented founders, if you will, uh, have a hard time even making the screening many
Yeah.
times. They
No,
get screened
absolutely.
out.
Yeah.
And you know the numbers, the capital numbers are very,
Yeah.
very low that
They're
go to
horrible.
this sector. Yeah.
It's still less
So
than 3% when I was a founder, and it's still that right now.
I know. I
I
mean,
was like, how did it not change? I feel like I've grown
but
up so much.
I know, but it's like, it's 20 years and we're still talking about this. It's just
Ever.
like, and then we get hit with other people that don't think that we should even be doing this, that we should even be focusing on any of these sectors. So it's very challenging, but I love the ecosystem, and I love dealing with founders.
That's really great. And so, I know that finding people from diverse and underrepresented groups is something that is very near and dear to you. I was wondering, where do you find the best kinds of sourcing for people who are generally like not in every single pitch room ever? You know who I'm talking about.
I know
So
who you're talking about, and
how do you kind of steer away from that to find the rest of the population, which is really a big portion?
it
Um,
is it is it is, and we have a very diverse, if you will, deal flow ecosystem. One of the areas that we have been partnering as of late has been the Venture Alliance Group in New York City. It's a group that has been sponsored by the city of New York Economic Development
yeah,
Corporation.
I know Fernando. He's
And
great.
yeah, Fernando Montejo is great, and he has been able to identify literally over 100, 160, 180 different early stage investable companies
Yeah,
vetted.
yeah,
So we are part of that. We're
that's
doing the
great.
accelerator to sort of find other people that you know fall through the transom, if you will, and don't have the network, or don't know how to make those connections. So we have a website that you could go in and put your application. We just finished our first cohort
Yeah,
in May. There'll be another cohort. The applications that we'll be due in November. So we have 2 cohorts a year of about 7, 8 companies. And we also go to community boards, chamber of commerce, have a very tight connection with a city college, city university. I'm part of the advisory board there. Uh, Ostos Community College, which is like 5,000 students, 90% of them are underrepresented, and women students in a community college area, which is a very good area to uh, inter in, interject ourselves to help those students choose STEM careers and STEM courses, because that leads to a higher probability of being able to get funded when you do an early stage you know invest an early stage company. So we are looking at different areas where typical VCs and angels don't look. We're also part of the Angel Capital Association, which in the last few years have been focusing on identifying this cohort of folks that we like, we think need help, and also just through we take companies that folks that just reach us through our website.
that's great. So what's next for Aspira?
What's next for Aspira is to we do the finalization of closing this fund. As I said, it closes June 30th, uh, and really starting our next fund, where we hope to raise somewhere between 25 and 50 million to from our existing investors and others that share our vision. We As I mentioned, we want to continue to focus on this accelerator that we just really have been involved the last year or two. And the third thing that we want to do is start an endowment with one of these colleges, a significant endowment, a seven-figure endowment, to provide scholarships to students that want to study STEM, whether it's engineering or computer science, or, anything like that. Women and people of color are underrepresented in that area, and we
Yeah.
want to do that. So if we can get that off the ground by December 31st, I'll consider that a big win, because that would be a legacy kind of activity. And it also would differentiate us in terms of the fact that we want to put our money where our mouth is.
Hmm. And even the women and underrepresented groups that go into the schools, they don't actually work in those fields afterwards, because
No.
it's such an unfavorable environment for a number of reasons that are still happening. And so you have these very highly educated academics that then don't feel like that next step is still correct for them because the environment is still not there.
It's so true. And, we've been talking about this for literally decades, and it's still true. And it's very hard to address that. I think that we are making progress. You are seeing more and more folks trying to address it. I think it has to come from the private sector more than the government sector. It has to be a partnership, if you will, but it's still difficult. It's a cultural thing. So,
Yeah.
it's tough to change.
Yeah, that's absolutely true. Well, Benny, thank you so much for joining me today. This was really great to get to hear your journey and your perspective. I think that our audience would really enjoy it. And thank you, everyone, for joining in on another episode of Unlocking Venture Capital.
Thank you so much.